Before we begin, please note that I am not a licensed financial advisor or insurance professional. This video is for educational and informational purposes only and should not be considered financial or legal advice. The world of insurance is complex and state-specific. Always consult with a qualified and licensed professional in your state to discuss your individual needs before making any insurance decisions. Imagine this for a second. You're driving home from work, maybe listening to a podcast, thinking about dinner. The light turns green, you start to go, and bam! Someone runs the red light and plows right into your side. It's a bad one. Your car is totaled. Worse, you're injured. An ambulance ride, a hospital stay, months of physical therapy. Now, picture two versions of what happens next. In version 1, you make a few phone calls. Your car is replaced. Your medical bills, every single penny, are paid for. The income you lost while you couldn't work? A check for that amount shows up in your bank account. Your life, while disrupted, gets put back on track. In version 2, you make the same phone calls, but the person on the other end says, "I'm sorry, the other driver only had the state minimum coverage. It's not nearly enough to cover your bills." Suddenly, you're on the hook for a $50,000 hospital bill. You're draining your savings to make your car payments on a vehicle that's now a crushed heap of metal in a junkyard. You're facing a financial hole so deep you can't see the bottom. All because of a single piece of paper you probably signed without reading. Your auto insurance policy. The difference between those two realities is not luck. It's knowledge. And for the next few minutes, and over this entire series, I'm going to give you the knowledge that insurance companies count on you not having. We are going to pull back the curtain on one of the most confusing, frustrating, and important purchases you will ever make. This is not just another boring video about insurance. This is a masterclass designed to turn you from a confused customer into a confident, empowered consumer. By the end of this series, you will understand exactly what you're paying for, you'll know how to spot the gaps in your coverage that could ruin you, and you will have the tools to potentially save hundreds if not thousands of dollars a year while getting better protection. So let's start at the absolute beginning. What even is car insurance? Forget the jargon, the commercials, and the confusing documents for a second. At its core, insurance is just a simple promise based on a concept called shared risk. Think of it like this. You and 100 of your neighbors all worry about a tree falling on your house. The chances of it happening to any single one of you are low, but if it does, the repair cost is a catastrophic $10,000. So, you all agree to put $100 into a big pot. That pot now has $10,000 in it. You all go about your year, and sure enough, a big storm rolls through and a tree smashes your neighbor Dave's roof. It's a disaster for Dave, but the community pot pays the $10,000 to fix it. Everyone is out $100, but Dave was saved from financial ruin. That's it. That is all insurance is. It's a giant, professionally managed pot of money that you and millions of other drivers pay into. You pay a small, predictable amount, your premium, in exchange for a promise that if something unpredictable and catastrophic happens, the big pot of money will be there to cover the massive costs. You are trading a small, certain loss for protection against a huge, uncertain loss. The insurance company is just the manager of that pot. Every single type of coverage we're about to discuss is just a different rule about when and how you can take money out of that pot. And generally, all those rules fall into three main categories. Your policy is designed to protect three things. Number 1, other people and their property. Number 2, you and your passengers. And number 3, your actual car. For the rest of this video, we are going to focus entirely on the first one, because it's the most important and it's the one part of your insurance that is legally required in nearly every state in America. This is liability coverage. Liability coverage does not pay for your car. It does not pay for your medical bills. Liability coverage pays for the damage you cause to other people when an accident is your fault. It is your financial shield. If you crash into someone's brand new Mercedes, your liability coverage pays to fix or replace it. If you cause an accident that injures the other driver and their passengers, your liability coverage pays for their ambulance rides, their hospital stays, their lost wages, and potentially their pain and suffering. Without it, all of that would come directly out of your pocket. Your savings, your investments, your future wages, all of it would be on the line. Liability coverage is broken down into two parts. You'll see it on your policy as bodily injury liability and property damage liability. Bodily injury, or BI, covers medical expenses, pain and suffering, and lost wages for people you injure in an at-fault accident. Property damage, or PD, covers the cost to repair or replace the property you damage. This usually means someone else's car, but it could also be a mailbox, a storefront, a guardrail, or a city light pole. Now here is the most critical part, the section that you absolutely need to understand. When you buy liability insurance, you buy it in specific amounts called limits. These limits are the absolute maximum amount your insurance company will pay out for an accident. Anything above that limit is your personal responsibility. You'll see these limits written as a series of 3 numbers, like 25/50/25. This is called a split limit, and it's the secret code that determines how protected you really are. Let's break down what that code means. The first number represents the maximum amount in thousands of dollars that your insurance will pay for bodily injury to a single person you injure. So a 25 means your policy will pay up to $25,000 for one person's injuries. The second number is the maximum amount your insurance will pay for bodily injury for the entire accident, no matter how many people are hurt. A 50 means if you injure 3 people, the policy will pay out a total maximum of $50,000 to be split among all of them. The third number is the maximum amount your insurance will pay for all property damage in an accident. A 25 here means your policy will pay up to $25,000 to fix or replace whatever car, or cars, or property you hit. So 25/50/25 means $25,000 for one person's injuries, $50,000 total for all injuries in the accident, and $25,000 for property damage. Here's the scary part. Many states only require you to carry these rock-bottom minimum limits. And millions of people trying to save a few bucks a month choose these minimums. This is one of the biggest financial mistakes a person can make. Let's run the numbers on a very average, everyday accident. You're not paying attention for 2 seconds and you rear-end a brand new Ford F-150. The driver and his wife both complain of neck and back pain. Seems minor, right? Well, the average price of a new car in the United States today is nearly $50,000. Your $25,000 property damage limit? It's exhausted before you even get the estimate back from the body shop. You are now personally on the hook for the remaining $25,000 to replace that truck. Your savings account is gone. Meanwhile, the couple in the truck goes to the hospital. An emergency room visit, an MRI, a few doctor's appointments, and some physical therapy can easily cost $20,000 to $30,000 per person. Your bodily injury limit is $25,000 for one person. So you're already in trouble. And your total limit for the whole accident is only $50,000. Their combined bills could be $60,000 or more, not even counting the wages they lost from work or a potential lawsuit for pain and suffering. In this completely believable, everyday fender bender, you are now facing a personal bill of $50,000, $60,000, maybe $100,000 that you have to pay, all because you chose the cheapest insurance. The state minimum isn't a recommendation. It's a legal floor designed to provide a tiny bit of protection for other drivers. It is not designed to protect you or your assets. This is why understanding liability is so non-negotiable. It's the foundation of your entire financial security every time you get behind the wheel. Choosing higher limits like 100/300/100 or even 250/500/250 often costs just a few dollars more per month, but it increases your protection exponentially. It's the difference between a bad day and a life-altering financial catastrophe. So we've covered the crucial shield that protects you from damaging others. But what about you? What about your own medical bills? And what about the 1,000-pound piece of metal and technology you drive every day? If liability covers them, what covers you and what covers your car? That's where the other 2 pillars of protection come in, and they are just as vital to understand if you want to be truly covered when disaster strikes. Let's start with a scenario. You're driving home on a rainy Tuesday night. You're being careful, but the car in front of you slams on its brakes unexpectedly. You react, but the roads are slick and you can't stop in time. It's a classic low-speed rear-end collision. That sinking feeling hits your stomach. Everyone's okay, which is the most important thing, but both cars are damaged. Your front bumper is crumpled, and one of your headlights is shattered. Now, based on what we talked about before, you know your liability insurance is going to step up. It's your I'm sorry fund. It will pay to fix the other driver's car because you were at fault. Their trunk will be repaired, their bumper replaced, all on your policy's dime. The other driver, after the initial frustration, will eventually be made whole. But what about you? You're standing on the side of the road, looking at the front of your own car, and a chilling thought crosses your mind. Who pays for this? Your liability coverage just paid out for the other guy. It does absolutely nothing for your crumpled bumper and your shattered headlight. You are on your own. Unless, that is, you have the second pillar of protection, collision coverage. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a street light, a guardrail, a garage door you misjudged, or a tree you swerved to miss. The key here is that it covers your car, and here's the most important part. It covers you regardless of who is at fault. If you cause the accident, your collision coverage fixes your car. If the other guy causes the accident, you could file a claim against his liability insurance, but that can be a slow, painful process. You have to wait for his insurance company to accept fault, you have to deal with their adjusters, and if they decide to fight it, you could be waiting weeks or even months for a check. With your own collision coverage, you just call your company. You say, hey, this happened, and they start the process of getting your car fixed right away. They'll then go after the other driver's insurance company to get their money back. A process called subrogation, but you don't have to worry about that. You're already back on the road. Now, collision coverage isn't a magic blank check. It comes with a crucial component you need to understand: the deductible. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company starts paying. Think of it as your share of the cost. Deductibles typically range from $250 to $1,000, sometimes even more. Let's go back to our rainy Tuesday night accident. Let's say the repair estimate for your car comes in at $4,000. If you have a $500 deductible, you pay the first $500 to the body shop. Your insurance company then pays the remaining $3,500. If the damage was only, say, $400, you'd pay for it all yourself because the cost is less than your deductible. You wouldn't even file a claim. Choosing your deductible is one of the biggest decisions you'll make. It's a balancing act. A lower deductible like $250 feels safe. If something happens, you won't have to come up with much cash. But that safety comes at a price. Your monthly or semi-annual premium will be higher. On the flip side, a higher deductible like $1,000 will lower your premium, saving you money on a regular basis. But you have to be honest with yourself. Could you comfortably write a check for $1,000 tomorrow if you had to? If not, a higher deductible might be a dangerous gamble. So now you're feeling pretty good. You've got liability to cover others, and collision to cover your own car in an accident. You're protected, right? Well, let's imagine a different kind of bad day. You park your car at the mall to do some shopping. When you come out 2 hours later, you find a spider web of cracked glass on your windshield, and a huge dent in your roof from a falling tree branch. Or you wake up one morning and your car is just gone, stolen from your driveway. Or maybe you live in an area prone to severe weather, and a hailstorm turns the hood of your car into a golf ball. In every one of these situations, you haven't collided with anything. You weren't even driving. So your collision coverage won't do a thing. This is where the third pillar of protection comes in, and it's the one that covers you from the sheer randomness of the universe: comprehensive coverage. Comprehensive, sometimes called other than collision coverage, is the catch-all for almost everything else that can damage your car. Think of it as your protection against bad luck and acts of God. It covers a huge range of incidents: theft, vandalism, fire, falling objects, explosions, earthquakes, windstorms, hail, flooding, and even hitting an animal. That last one is a big one that confuses a lot of people. If you swerve to miss a deer and hit a tree, that's a collision claim. But if you don't swerve and you hit the deer directly, that's a comprehensive claim. It's a weird distinction, but it's how the industry works. The logic is that the deer is a random, unpredictable event, more like a falling object than a stationary one. Just like collision, comprehensive coverage has its own deductible. It works the exact same way. If your car is stolen and never recovered, your insurance company will cut you a check for the actual cash value of your car, minus your comprehensive deductible. If a hailstorm causes $2,000 in damage and you have a $500 deductible, you pay $500, they pay $1,500. Often, you can choose different deductibles for collision and comprehensive. Many people opt for a lower comprehensive deductible because those claims, like a cracked windshield, are often more frequent and less expensive than a major collision. Now, when you put these three pieces together, liability, collision, and comprehensive, you get what people in casual conversation call full coverage. You'll hear it all the time. Oh, I've got full coverage. But here's a pro tip. Full coverage is not an official insurance term. It's slang. If you call an agent and say, "Give me full coverage," they'll know you mean you want all three main types of protection. But it's important to know it's not a single product. It's a bundle of separate coverages. So, who needs this so-called full coverage? Well, if you have a loan or a lease on your car, the answer is simple: you do. In fact, you don't have a choice. Your lender, the bank or credit union that financed your car, requires you to have both collision and comprehensive. Why? Because until you make that final payment, the car is technically their asset. It's the collateral for your loan. They are protecting their investment. If you wreck that car and don't have the coverage to fix it, they're out a lot of money. They won't let that happen. But what if you own your car outright? What if you're driving a 10-year-old Honda that's fully paid off? Do you still need collision and comprehensive? This is where it becomes a personal financial decision. You have to weigh the cost of the coverage against the value of your car. Ask yourself this: what is my car worth right now? Not what I paid for it, but what could I sell it for today? You can look this up online in a few minutes. Let's say your car is worth $3,000. And let's say you have a $1,000 deductible. If you get into a major accident, the absolute most your insurance company will pay you is $2,000. Now, how much are you paying per year for that collision and comprehensive coverage? If it's $500 or $600 a year, are you willing to pay that much to protect a potential $2,000 payout? Maybe, but maybe you'd be better off canceling that coverage, saving that $600 a year, and putting it into a dedicated savings account for car repairs or a down payment on your next car. This is essentially self-insuring. There's no single right answer. For a car worth $10,000, keeping the coverage is probably a no-brainer. For a car worth $1,500, dropping it is likely the smarter move. The gray area is in between, and it depends on your personal risk tolerance and financial situation. So we've covered the other guy's car. We've covered your car from accidents. And we've covered your car from pretty much everything else. We've rebuilt the vehicles. But what about the most important thing of all? What about the people inside them? What happens when you get hurt? What happens when your passengers get hurt? And what happens if the person who hits you has zero insurance at all? That's where the costs can go from thousands for a car repair to hundreds of thousands in medical bills. And the coverages get even more critical. And this is the exact moment where car insurance stops being about just fixing a dented fender and starts being about protecting your health, your family, and your entire financial future. The first two coverages we're going to talk about are designed to answer that first question. What happens when you or your passengers get hurt? They are medical payments coverage, often called MedPay, and personal injury protection or PIP. Think of these as your immediate medical fund after an accident. Let's say you're driving with a friend, and you get into a minor fender bender. It's your fault. You're both a little shaken up. Your friend says they're fine, but the next day their neck is stiff, and they decide to go to an urgent care clinic for a checkup. Who pays for that? Your health insurance won't cover your friend. Your liability coverage, which we just discussed, could eventually pay, but that can take time, involve lawyers, and requires proving fault and injury extent. It's not designed for quick, small payments. This is where MedPay shines. MedPay is optional in most states, but it's a lifesaver. It covers medical expenses for you and your passengers, regardless of who was at fault for the accident. It's like a no-questions-asked medical credit card for a car crash. It covers things like ambulance rides, emergency room visits, doctor's appointments, x-rays, even dental work if you injured your teeth in the crash. It pays out quickly, without the hassle of determining fault. If your friend's urgent care visit costs $300, your MedPay can cover it, period. This prevents a small accident from turning into an awkward, friendship-ending dispute over money. It also covers you if you're injured as a pedestrian or cyclist hit by a car. Now, some of you might be thinking, but I have great health insurance. Why do I need MedPay? That's a great question. First, your health insurance has deductibles and copays. A single ER visit can easily cost you $500 or $1,000 out of pocket before your health insurance even starts paying. MedPay can be used to pay for that deductible. Second, health insurance doesn't cover your passengers, but MedPay does. Third, health insurance doesn't cover things like funeral expenses, God forbid. MedPay often does. In about a dozen states known as no-fault states, this concept is taken a step further with personal injury protection, or PIP. If you live in a no-fault state like Florida, New York, or Michigan, you are required to carry PIP. It's similar to MedPay in that it covers your medical bills regardless of fault, but it's usually much more comprehensive. The biggest difference is that PIP can also cover non-medical costs, like lost wages if the injury from the accident causes you to miss work. It might even cover things like hiring someone to help with household chores if you're unable to do them yourself while recovering. The idea behind no-fault laws and PIP is to reduce lawsuits for minor injuries and ensure that everyone gets their medical bills paid quickly without having to fight in court. So MedPay and PIP are your first line of defense for the people inside your car. But now we have to address that second, much scarier question. What happens if the person who hits you has no insurance at all? Or they have the absolute bare minimum required by law, which often isn't enough to cover a serious accident. This is, without a doubt, one of the most terrifying and financially devastating situations a driver can face. Statistics show that roughly 1 in 8 drivers in the United States is uninsured. That's more than 12% of people on the road who are breaking the law and have absolutely no way to pay for the damage they might cause you. If one of them plows into your new car, totaling it, and sends you to the hospital for a month, you could be left with $100,000 in medical bills, a $50,000 car loan to pay off for a vehicle that's now a heap of scrap metal, and no way to get a dime from the person who caused it all. You can sue them, sure, but you can't get blood from a stone. If they don't have money for insurance, they don't have money to pay your lawsuit judgment. This is where your own insurance policy becomes your hero. This is the role of uninsured and underinsured motorist coverage. Let's call it UM/UIM for short. This is not optional. I mean, legally it might be optional in your state, but in terms of protecting your life savings, it is absolutely essential. Think of UM/UIM as a shield. It's you buying insurance on behalf of the irresponsible driver who might one day hit you. When an uninsured driver hits you, your own insurance company steps into the shoes of the at-fault driver's insurance that should have existed. Your company pays for your damages, and then they can go through the legal nightmare of trying to get the money back from the uninsured driver so you don't have to. This coverage is typically split into 2 parts. First, there's uninsured motorist bodily injury, or UMBI. This covers your medical bills, your passengers' medical bills, pain and suffering, and lost wages when you're hit by a driver with no insurance. Second, there's uninsured motorist property damage, or UMPD. This pays to repair or replace your car if it's damaged by an uninsured driver. Now let's talk about the evil twin, the underinsured motorist. This might be even more common. This is the person who did the absolute minimum. They bought a policy that meets the state's legal requirement, but nothing more. Let's say your state requires drivers to have $25,000 in bodily injury liability. That sounds like a lot of money, right? But one serious accident with a broken leg, surgery, and a few nights in the hospital can blast past that $25,000 limit before you're even discharged. Imagine you're in a serious accident caused by a driver with that minimum coverage. Your medical bills total $80,000. The other driver's insurance will write you a check for their policy limit, $25,000. That's it. That's all they're legally required to pay. You are now personally on the hook for the remaining $55,000. Your life has been turned upside down by someone else's mistake, and now you have a debt the size of a new luxury car hanging over your head. This is where underinsured motorist coverage, the UIM part, saves you. If you had an underinsured motorist policy with a limit of, say, $100,000, your own insurance company would step in and pay that $55,000 difference. They bridge the gap between what the at-fault driver's cheap policy covers and what your bills actually are. Let me be crystal clear. The few extra dollars a month that UM/UIM coverage costs is the single best investment you can make in your financial security on the road. It protects you from the irresponsibility of others. When you get a quote, insurance companies will often default to the lowest possible limits for this coverage to make the price seem cheaper. Do not accept this. You should always have your uninsured and underinsured motorist limits match your own bodily injury liability limits. If you have decided you need $100,000 of liability coverage to protect your assets if you hurt someone else, then you absolutely need that same $100,000 shield to protect yourself if an uninsured driver hurts you. So, to recap, we've now built a policy that protects other people from damage you cause with liability coverage. And we've added a crucial layer of protection for ourselves and our passengers with MedPay or PIP for immediate medical needs, and the uninsured/underinsured motorist shield to protect us from the millions of drivers who have little or no insurance. We've covered your responsibility to others, and we've covered your personal protection from others. But we still haven't talked about protecting the value of your own car from, well, almost everything else. What happens when you back into a pole in a parking garage? What happens when a deer jumps out in front of you on a country road? What if a hailstorm turns your car's roof into a golf ball? Or a thief smashes your window and steals your car from your driveway? None of the coverages we've discussed so far would pay for any of that. For that, you need 2 of the most common and most vital parts of any full coverage policy. And in the next part, we're going to break down exactly what they are, how they work, and when you absolutely need them. These two coverages are called collision and comprehensive, and if you have a car loan or a lease, you almost certainly have them because the bank requires them. But if you own your car outright, they're optional. And understanding what they do is the key to deciding if you're spending money wisely or just throwing it away. Let's start with collision. The name is pretty self-explanatory. Collision coverage pays to repair or replace your own car after it's damaged in, well, a collision. This could mean hitting another car, or it could mean hitting a stationary object like a telephone pole, a guardrail, a fence, or that sneaky concrete pillar in the grocery store parking lot. The key thing to remember is that you were in control of the vehicle when it hit something. Now let's go back to our story from the last part. You caused that accident. Your liability coverage paid for the other driver's brand new SUV, their medical bills, and their lost wages. You're off the hook for that $100,000. But now you're standing on the side of the road, looking at your own car. The whole front end is crumpled. The radiator is leaking. The hood is bent into a V shape, and the headlights are shattered. It's undrivable. You get it towed to a body shop, and the mechanic gives you the bad news. It's going to cost $7,000 to fix. If you only have liability insurance, your insurance company will say, "We're sorry to hear that. Let us know if you need a list of local mechanics." They won't pay a single penny. That $7,000 bill is entirely on you. For most people, that's a devastating budget-destroying expense. But if you have collision coverage, the story changes completely. You call your insurance company, file a claim, and an adjuster comes out to look at the car. They confirm the repair cost is $7,000. Now here's where a new incredibly important word comes into play: your deductible. A deductible is the amount of money you have to pay out of pocket for a repair before your insurance company starts paying. Think of it as your share of the cost. Deductibles for collision coverage are typically $500 or $1,000. You choose this amount when you buy your policy. A higher deductible means you pay a lower monthly premium, because you're agreeing to take on more financial risk yourself. A lower deductible means a higher monthly premium, because the insurance company is on the hook for more. Let's say you chose a $1,000 deductible. In our $7,000 repair scenario, you would pay the body shop the first $1,000. Your insurance company would then pay the remaining $6,000. You just turned a $7,000 catastrophe into a manageable $1,000 problem. That is the power of collision coverage. It protects the investment you made in your own vehicle. So, collision covers you when you hit something. But what about all the other ways a car can be damaged? What if a tree branch falls on it during a storm? What if it gets stolen? What if you're driving down a country road at dusk, and a deer jumps out in front of you? Hitting an animal is not considered the same as hitting a concrete pillar. None of these events are technically a collision, in the way insurance defines it. And for that, you need the second piece of the puzzle: comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It covers damage to your car from basically anything that isn't a crash. This is your protection against the random, unpredictable chaos of the world. The list of things it covers is long: theft, vandalism, fire, flooding, hail, windstorms, falling objects, riots, and yes, hitting an animal. Let's imagine a different scenario. You wake up one morning, and a massive hailstorm has rolled through your neighborhood overnight. You look outside, and your car, which was parked on the street, now has hundreds of dents all over the roof, the hood, and the trunk. It looks like a giant golf ball. You take it to the shop, and the adjuster says the damage is so extensive that it would cost more to fix than the car is actually worth. They declare it a total loss. Your car is worth $15,000. Again, if you only have liability, you get nothing. If you have collision, you also get nothing because you didn't collide with anything. But with comprehensive coverage, you're protected. Just like collision, comprehensive has a deductible. Let's say yours is $500. The insurance company will take the value of your car, $15,000, subtract your $500 deductible, and cut you a check for $14,500. You can now use that money to go buy a new car. You've been made whole again. Comprehensive coverage saved you from losing your entire $15,000 asset because of some bad weather. So when you hear someone say they have full coverage, this is what they almost always mean. Full coverage isn't an official insurance term you can buy. It's just common slang for a policy that bundles together three things: liability, collision, and comprehensive. Protects other people and it protects you. Now for the big question: do you actually need collision and comprehensive? The answer has two parts. First, if you have a loan on your car or you are leasing it, the answer is a simple, non-negotiable yes. You are required to have them. Why? Because until you pay it off, you don't fully own your car. The bank or the finance company does. They are the lien holder. They have a financial interest in that vehicle. And they are not going to let you drive around with their multi-thousand-dollar asset unprotected. If you total the car, they want to make sure there's an insurance policy that will pay them back the money they're owed. It's a non-starter. If you have a loan, you need full coverage. Period. But what if you own your car outright? You paid cash for it or you just made your final loan payment? Congratulations. Now the choice is yours. And this is where you have to do some simple math and be honest with yourself. The decision to keep or drop collision and comprehensive should be based on two things: the value of your car and the size of your emergency fund. Let's say your car is an older model, a trusty sedan that's worth about $2,000. Your collision deductible is $1,000. If you get into an at-fault accident and total it, the absolute most your insurance company would ever pay you is $1,000, the $2,000 value of the car minus your $1,000 deductible. Now ask yourself, how much are you paying per year for that collision coverage? It might be $300, $400, or $500. Is it worth paying $500 every year to protect yourself from a potential $1,000 loss? Maybe not. You might be better off dropping the coverage, saving that $500 a year in a dedicated car repair bank account, and effectively self-insuring. If, on the other hand, your car is worth $30,000, the math looks very different. Dropping collision and comprehensive would be an enormous gamble. Could you easily write a check for $30,000 to replace it if it were stolen or totaled tomorrow? If the answer is no, then paying a few hundred extra dollars a year for full coverage is one of the smartest financial decisions you can make. It's a small, predictable cost to protect you from a large, unpredictable, and potentially life-altering expense. So, we've built the foundation of a solid car insurance policy. We have liability to protect us from bankrupting ourselves by hurting others. And we have collision and comprehensive to protect our own vehicle from damage or loss. For most people, this full coverage package is what they have and what they need. But it's not the whole story, because there's a terrifyingly common scenario that none of these coverages will help you with. What happens when you're the one who gets hit? The other driver is clearly at fault. Your car is wrecked and you're injured. Their liability insurance should pay for everything, right? But what if they don't have insurance? Or what if they have the absolute bare minimum coverage required by the state, and your medical bills are 10 times that amount? Now you're the victim, and you're still facing financial ruin. To protect yourself from that nightmare, you need two more types of coverage that are just as vital as the big three. And we're going to break them down next. These two coverages are called uninsured motorist and underinsured motorist protection. And trust me, by the end of this, you'll see them not as an optional add-on, but as an absolute, non-negotiable shield for your financial life. Let's start with the first one. Uninsured motorist coverage, or UM. The name says it all. This coverage pays for your injuries and, in some cases, your property damage if you're hit by a driver who has zero insurance. Think of it as a stand-in for the liability insurance the other guy was supposed to have. Let's paint a picture. You're sitting at a red light, minding your own business, maybe singing along to the radio when bam, you get rear-ended. The other driver gets out, they're apologetic, but then they drop the bomb. I don't have any insurance. Without uninsured motorist coverage, what happens next is a nightmare. Your health insurance might cover some of your initial medical bills, but what about the giant deductible? What about the physical therapy you'll need for the next 6 months? What about the wages you lose because your whiplash is so bad you can't sit at your desk and work? You're left holding the bag. Your only real option is to sue the other driver personally. But let's be honest, if someone can't afford a basic car insurance policy, what are the chances they have tens of thousands of dollars in assets just sitting around for you to claim? The odds are practically zero. You're trying to get blood from a stone, and in the meantime the hospital bills are piling up. This is where uninsured motorist coverage swoops in like a superhero. It comes in two main flavors: uninsured motorist bodily injury, or UMBI, and uninsured motorist property damage, or UMPD. UMBI is the big one. It covers your medical expenses, your passengers' medical expenses, lost wages, and even compensation for pain and suffering. If that uninsured driver puts you in the hospital for a week, UMBI is what pays for that hospital stay, the surgeon, the follow-up appointments, all of it, up to the limits you choose. This is the coverage that prevents a car accident from turning into personal bankruptcy. Then there's UMPD. This covers the cost of repairing your car when an uninsured driver damages it. Now, a quick heads up. Not every state offers UMPD. In states that don't, or if you choose not to get it, your own collision coverage would handle the repairs. We'll talk all about collision coverage in the next part. But for now, just know that UMPD is a direct way to fix your vehicle without dipping into your own pocket after being hit by someone with no insurance. And here's a massive reason why UM is so critical. It also covers you in a hit and run. If someone smashes into your car and then speeds off into the night, who pays for the damage? From the insurance company's perspective, a driver you can't identify is the same as a driver who has no insurance. So your uninsured motorist coverage kicks in to handle your injuries and fix your car. Without it, a hit and run would leave you completely on your own to pay for everything. So that's uninsured motorist. But what about that other scenario we talked about? The driver who has insurance but just the bare minimum? This is where UM's equally important sibling comes into play. Underinsured motorist coverage, or UIM. Let's go back to that red light. Bam! You get rear-ended again. This time the driver who hit you is responsible and they have insurance. You breathe a sigh of relief. But then you find out they only have the state minimum liability coverage. Let's say your state requires just $25,000 in bodily injury liability. That sounds like a lot of money, until you get the bill from the emergency room. A single night in a US hospital can cost thousands. An ambulance ride and MRI surgery for a broken bone. You can blow past $25,000 before you're even discharged. Let's say your total medical bills and lost wages come out to $80,000. The at-fault driver's insurance will write you a check for their policy limit, $25,000. That's it. That's all they're legally required to pay. So now what? You're still short $55,000. This is the gap. This is the financial black hole that underinsured motorist coverage is designed to fill. With UIM coverage on your policy, once the other driver's insurance has paid out its maximum, your own policy steps in to cover the rest, up to your UIM limit. If you had $100,000 in UIM coverage, it would easily cover that remaining $55,000 gap. You'd be made whole. Without it, you'd be on the hook for an amount of money that could cripple you financially for years, all because the person who hit you decided to save a few bucks a month by getting the cheapest policy possible. You might be thinking, what are the odds of this really happening? The odds are shockingly high. The Insurance Research Council estimates that about 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. That means on your average commute, you will likely pass dozens, if not hundreds, of cars with no insurance at all. And that number skyrockets in certain states. In some places, it's as high as 1 in 4. And that's just the completely uninsured. The number of underinsured drivers is even higher. Millions of people carry only the legal minimum liability, which, as we've seen, is often tragically inadequate for a serious accident. You are sharing the road every single day with people who are one mistake away from causing you a level of financial damage they could never hope to repay. You can't control their choices. You can't force them to be responsible. But you can protect yourself from the consequences of their irresponsibility. That is the entire point of UM and UIM coverage. It's insurance on other people's bad decisions. Some states actually require you to have this coverage, and for good reason. But in many states, it's optional, and your insurance agent might even ask you to sign a waiver to decline it. My advice? Don't do it. The peace of mind is worth every single penny. And speaking of pennies, UM and UIM are typically some of the most affordable coverages you can add to your policy. We're often talking about just a few extra dollars a month to get a massive safety net worth $50,000, $100,000, or even $300,000. The return on investment is astronomical if you ever need it. Now for a pro tip. When you're buying UM/UIM, you might hear the term stacking. This is a powerful feature available in some states. Let's say you have 2 cars on your policy, and you have $100,000 of UM coverage on each car. If you have unstacked coverage, your limit is $100,000 per accident, period. But if you pay a little extra for stacked coverage, you can combine or stack the limits from both cars. So in an accident, you now have $200,000 of available coverage. It's a way to significantly boost your protection, especially for families with multiple vehicles. Always ask your agent if stacking is an option for you. So let's put it all together. Liability coverage, which we covered before, is about protecting your assets from others if you cause an accident. It's about your responsibility. Uninsured and underinsured motorist coverage is the other side of that coin. It's about protecting your health and your assets from others when they cause an accident and can't pay for it. You need both. A policy with high liability limits but no UM/UIM is like building a fortress with a giant, unlocked back door. We've now covered how to protect other people and how to protect yourself from other people. But we still haven't talked about protecting the single most expensive piece of physical property in this whole equation. Your car itself. What happens if you cause the accident? Or if a tree falls on your car? Or if it gets stolen? For that, you need two more critical pieces of the puzzle. And that's exactly where we're headed next. So let's talk about that first piece of the puzzle, collision coverage. The name is pretty straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object, or if it overturns. This is the coverage that kicks in when you are deemed at fault for an accident. Remember in the last part, we talked about your liability coverage paying for the other person's car when you're at fault? Well, collision is the part that pays for your car in that same scenario. Let's paint a picture. You're leaving the grocery store, you're in a rush, you're thinking about what to make for dinner, and you back out of your parking spot a little too quickly. Crunch! You just back directly into one of those thick concrete pillars in the parking garage. Your bumper is destroyed, your taillight is shattered. It's clearly your fault. You can't exactly sue the pillar. This is a classic collision claim. Your bodily injury and property damage liability won't do a thing for you here, because they're designed to pay for damage you cause to others. Collision is for you. It covers hitting another car, a pole, a wall, a guardrail, you name it. If you collide with it, this is your coverage. But here's the most important concept to understand when it comes to collision, and it's a word you're going to hear a lot: deductible. A deductible is the amount of money you have to pay out of your own pocket for a claim before your insurance company starts to pay. Think of it as your share of the cost. You choose your deductible amount when you buy your policy. Common amounts are $500, $1,000, or even $2,500. Let's go back to that parking garage pillar. You take your car to the body shop, and they quote you $4,000 to fix the damage. Let's say you have a $1,000 collision deductible. Here's how it works. You pay the first $1,000 directly to the repair shop. Then, your insurance company pays the remaining $3,000. If the damage was only $800, you'd pay the entire amount yourself because the cost is less than your deductible. You wouldn't even file a claim. Now, why would anyone choose a high deductible like $2,500? It's all about a trade-off. A higher deductible means you're taking on more financial risk yourself. In return, the insurance company gives you a lower premium, a lower monthly or semi-annual bill. A lower deductible, like $500, means the insurance company takes on more risk, so they charge you a higher premium. The golden rule is to choose a deductible that you could comfortably pay tomorrow without warning if you had to. Don't pick a $2,500 deductible to save $20 a month if you don't have $2,500 available in an emergency fund. Okay, so that's collision. Covers you when you hit something. But what about all the other chaos the world can throw at your car? What about the things that have nothing to do with your driving? A hailstorm that turns your car's roof into a golf ball. A thief who smashes your window and steals your stereo, or worse, steals the entire car. A deer that decides to play chicken with you on a country road at dusk. For all of that, you need the second piece of the puzzle: comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is actually a perfect description. It covers damage to your car from basically anything that is not a collision or an overturn. It's for the random, the unexpected, the acts of God. Fire, theft, vandalism, falling objects like a tree branch, floods, earthquakes, riots, and this is the one that surprises most people: hitting an animal. Yes, you heard that right. If a deer runs out in front of you and you hit it, that is a comprehensive claim, not a collision claim. It might feel like a collision, but in the eyes of insurance, it's an encounter with an animal, and that falls under comp. Now, here's a crucial distinction. If a deer runs out and you swerve to avoid it, and in doing so you run off the road and hit a tree, that's a collision claim. Why? Because the direct cause of the damage was your car colliding with a tree, not the animal itself. It's a subtle but incredibly important difference that can determine which part of your policy and which deductible applies. And just like collision, comprehensive coverage has a deductible. It works the exact same way. Let's say a major hailstorm rolls through your town, and your car suffers $5,000 in damage. If you have a $500 comprehensive deductible, you'll pay the first $500, and your insurance will cover the remaining $4,500. You can have different deductible amounts for collision and comprehensive, It's common for people to have a lower deductible for comprehensive because claims are often less likely to be their fault, and the premium for it is usually cheaper than collision. Now, when you have liability plus collision plus comprehensive, you'll often hear this referred to as full coverage. This is one of the most misunderstood terms in the entire industry. Full coverage is not an official insurance product. It's just slang. It's a shorthand way of saying you have the big three components, but it doesn't mean you're covered for everything no matter what. You still have liability limits, those numbers we talked about before. You still have deductibles. So if you ever call an agent and say, "I want full coverage," a good agent will immediately ask, "Okay, what liability limits do you want? And what deductibles do you want for collision and comprehensive?" Don't let the slang fool you into a false sense of security. The details matter. So, the big question is, do you actually need collision and comprehensive? Unlike liability insurance, no state law requires you to have them. The requirement comes from a different place, your bank. If you have a loan on your car or you're leasing it, your lender will absolutely 100% require you to carry both collision and comprehensive coverage, with a deductible no higher than a certain amount, usually $1,000. Why? Because until you pay it off, the bank is the legal owner of that car. It's their asset, their collateral for the loan they gave you. They need to make sure that if you total the car, their investment is protected and they get their money back. But what if you own your car free and clear? What if you have the title in your hand? Now it's completely your decision. And the choice boils down to a simple financial question. What is your car worth, and could you afford to replace it if it were destroyed tomorrow? This is where you need to know your car's actual cash value, or ACV. That's what the insurance company will pay you if your car is totaled. It's market value right before the accident, minus your deductible. It's not what you paid for it. It's what it's worth today with depreciation. You can get a good estimate on sites like Kelley Blue Book or Edmunds. Here's a common rule of thumb many financial experts use. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's actual cash value, it may be time to consider dropping it. Let's say you have a 12-year-old sedan worth about $4,000. And let's say the portion of your insurance premium for collision and comp is $700 per year. You're paying $700 to protect a $4,000 asset. Is that worth it? Maybe. But maybe you'd be better off dropping the coverage, saving that $700 a year in a dedicated car repair or replacement fund, and effectively self-insuring. On the flip side, if you own a $30,000 SUV outright, paying $900 a year for collision and comp is almost certainly a smart move. The core question is always this. If your car was gone tomorrow, would writing a check for its replacement cause you a major financial hardship? If the answer is yes, you need the coverage regardless of the car's age or value. So we've protected other people's property, other people's bodies, and our own car. But what about the most valuable thing of all? Our own bodies. What about our medical bills after an accident? That's a whole different ballgame, and it's governed by two little acronyms that can save you from financial ruin: MedPay and PIP. And understanding the difference is absolutely critical. So let's break them down. Think of medical payments coverage, or MedPay, as the swift, no questions asked first responder for your medical bills. It's designed to be simple and fast. If you're in an accident, MedPay covers you, your family members, and any passengers in your car for medical expenses, up to your policy limit. This could be things like ambulance rides, emergency room copays, x-rays, dental work if you chip a tooth on the steering wheel, even chiropractic care. The absolute magic of MedPay lies in one beautiful phrase: regardless of fault. It doesn't matter if you caused the accident, if the other guy did, or if a deer jumped out of nowhere and you swerved into a ditch. If you are injured in connection with your vehicle, MedPay kicks in. You could even be a pedestrian hit by a car, or injured as a passenger in someone else's car, and your own MedPay policy can step in to help. It's your personal accident health fund. So why is this so important? Because the other driver's insurance, the one that's supposed to pay if they're at fault, can take weeks, even months, to process a claim and cut a check. They have to investigate, determine fault, and go through their own bureaucracy. But hospitals don't wait. They want their money now. MedPay bridges that gap. It pays out quickly, covering your immediate costs, so you're not getting collection notices while you're still trying to recover. It's a relatively inexpensive coverage, with typical limits ranging from $1,000 to $10,000, designed to handle those initial, painful out-of-pocket expenses. But here's the key limitation. MedPay only covers medical and, in the worst case, funeral expenses. It does nothing for the money you're losing while you can't work. It doesn't help you pay for someone to watch your kids while you go to physical therapy. It's a bandage for the wound, but not a support system for your life. And that is where personal injury protection, or PIP, enters the scene. If MedPay is the first responder, PIP is the entire trauma hospital and rehabilitation center combined. It's often called no-fault insurance, and it is a far more powerful and comprehensive coverage. Like MedPay, PIP covers your medical bills and your passengers' bills regardless of who was at fault. But that's where the similarities end. PIP goes so much further. The single biggest difference, and the one that can literally save you from bankruptcy, is that PIP covers lost wages. Let that sink in. Imagine you're a freelance web developer, a gig worker, or you just don't have a generous sick leave policy at your job. You get into a serious accident and the doctor says you can't work for 2 months. Your medical bills are piling up, sure, but the real terror is that your income has just dropped to zero. Your rent is still due. Your car payment is still due. You still need to buy groceries. This is the scenario that destroys families. MedPay can't help you here, but PIP can. It will reimburse you for a percentage of your lost income while you recover, keeping your financial life afloat. And it doesn't stop there. PIP can also cover what are called replacement services. This means if your injuries prevent you from doing your normal household duties, PIP can help pay for things like house cleaning, childcare, or even dog walking. It's designed to maintain your quality of life, not just patch up your physical injuries. It is a total life support system after a crash. So what's the catch? Why doesn't everyone just get PIP? Well, there are 2 reasons. First, it's more expensive than MedPay because it does so much more. And second, it's not available everywhere. Its availability is tied to a fundamental difference in how states handle car accident claims. This is where we need to talk about at-fault versus no-fault states. The majority of states in the US are at-fault states, also known as tort states. In these states, if someone crashes into you, they are responsible or at fault for your damages. You file a claim against their bodily injury and property damage liability insurance to get your car fixed and your medical bills paid. The system is based on proving who was wrong. In these at-fault states, MedPay is usually offered as an optional coverage you can add to your policy. It's a great idea to have it, to get that immediate cash for your copays while you wait for the other driver's insurance to eventually pay up. But about a dozen states are no-fault states. These include places like Florida, Michigan, New York, and others. These states decided that the whole process of fighting to prove fault, just to get your medical bills paid, was inefficient and clogged up the court systems. So they created a new rule. After an accident, you turn to your own insurance policy first to cover your injuries, up to a certain limit, no matter who caused the crash. That's why it's called no fault. You're not immediately concerned with blaming the other driver. You're focused on getting your own bills paid by your own insurer. And what coverage do you use to do that? You guessed it, personal injury protection. In no-fault states, carrying PIP coverage is almost always mandatory. The state requires you to have this comprehensive coverage because their system is built around you relying on it. So let's put this all together in a simple decision framework. Which one do you need? First, find out if you live in a no-fault state. If you do, the decision is likely made for you. You will be required to purchase PIP, and you'll need to make sure you get at least the minimum amount your state requires, though it's often wise to buy more. If you live in an at-fault state, you now have a choice to make. You can likely add either MedPay or, in some cases, optional PIP to your policy. How do you decide? You need to look at your other safety nets. Ask yourself, how good is my health insurance? If you have a fantastic plan with a low deductible and low copays, a small MedPay policy of a few $1,000s might be perfectly adequate to cover those initial out-of-pocket costs. But if your health insurance has a high deductible, say $5,000 or $10,000, MedPay or PIP becomes much more valuable. Here's a pro tip most people don't know. Car insurance is often the primary payer over your health insurance. This means after an accident, your MedPay or PIP money is used first, before your health plan ever gets a bill. You can use your MedPay or PIP coverage to pay your entire health insurance deductible. So instead of you having to come up with $5,000 out of pocket, your car insurance pays it for you. It's an incredible benefit. Next, ask yourself, how stable is my income? Do I have short-term disability insurance through my job? Do I have a lot of paid sick leave saved up? If the answer is no, if you're self-employed, a contractor, or work paycheck to paycheck, then PIP, if it's available in your state, is a non-negotiable, absolute lifesaver. The lost wages coverage alone is worth the extra premium. It's not just car insurance at that point. It's income insurance. So to recap the battle, MedPay is the lightweight, cheaper option focused purely on fast cash for medical bills. PIP is the heavyweight champion, covering medical bills, lost wages, and other life disruption costs, but it comes with a higher price tag and is mandatory in no-fault states. Understanding this difference isn't just about checking a box on a form. It's about looking into the future at a potential worst-case scenario and building a financial shield to protect not just your car, not just your body, but your entire way of life. So you've done everything right. You've got liability, collision, comp, and you've protected your own medical bills with PIP. You are a responsible driver. But what happens when the person who smashes into you isn't? What happens when they have zero insurance, or the bare minimum that doesn't even cover the damage to your bumper? You're left holding the bag. Unless you have the two most underrated and important coverages on your entire policy. And we're going to break those down next. These two coverages are uninsured motorist and underinsured motorist protection. And frankly, driving without them is one of the biggest gambles you can take on the road today. It sounds complicated, but the concept is brutally simple. It's insurance you buy to protect yourself from other drivers who made the irresponsible choice not to buy enough insurance, or any at all. Let's start with a hard number. According to the most recent data from the Insurance Research Council, about 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. In some states like Mississippi, it's closer to 1 in 4. In Florida and New Mexico, it's 1 in 5. Think about that. On your average commute, you will pass dozens, if not hundreds, of cars. Statistically, a significant number of them have zero ability to pay for the damage they might cause you. They are financial time bombs on wheels. So let's play out a scenario. You're driving home, you've got a green light, and someone blows through a red light and T-bones you. It's a bad one. Your car is totaled. You're rushed to the hospital with a broken leg and a concussion. The police report clearly states the other driver was 100% at fault. Great. Case closed, right? Their insurance will cover everything. But then you get the call. The other driver has no insurance. They let their policy lapse months ago. Suddenly, that 100% at-fault accident is 100% your problem. The at-fault driver? They might get a ticket, maybe lose their license. But they don't have money. They don't have assets. Suing them is like trying to squeeze water from a rock. It's pointless. So who pays for your totaled car? Who pays for your 5-figure ambulance ride and emergency room visit? Who pays for the surgery on your leg, the weeks of physical therapy, the MRI for your concussion? And who pays your salary for the month you can't work while you recover? Without uninsured motorist coverage, the answer is simple. You do. Every single penny comes out of your own pocket. Your life can be financially ruined in an instant by someone else's mistake. This is where uninsured motorist bodily injury, or UMBI, becomes your financial superhero. If you are hit by an uninsured driver who is at fault, your own insurance company steps in and acts as if they were the at-fault driver's insurer. They will pay for your medical bills, your follow-up treatments, your physical therapy. And crucially, they will also pay for your lost wages while you're unable to work. It even covers pain and suffering, something your health insurance would never, ever touch. It literally saves you from financial catastrophe. Now what about your car? That's where the other half of this coverage comes in. Uninsured motorist property damage, or UMPD. This coverage pays to repair or replace your vehicle if it's damaged by an at-fault, uninsured driver. Now you might be thinking, wait, doesn't my collision coverage do that? And you're right, it does. If you have collision, it will pay for your car repairs regardless of who is at fault. So why have UMPD? 2 big reasons. First, your UMPD deductible is often much lower than your collision deductible. We're talking maybe $250 versus a $1,000 deductible. Second, in some states, filing a UMPD claim is considered a not-at-fault accident and is less likely to raise your rates than a collision claim would be. It's an extra layer of specific protection. And here's a massive bonus. In most states, a hit-and-run is treated as an accident with an uninsured motorist. Someone sideswipes your car in a parking lot and takes off? UMPD can cover it. So that's the uninsured problem. But what about the underinsured problem? This one is even more common and far more insidious. This is where the other driver did the bare minimum. They bought car insurance, but they only bought the lowest amount required by law in their state. Let's go back to our T-bone accident. This time, the at-fault driver has insurance. Phew. You get the details, you file the claim. But then you discover that your state's minimum bodily injury liability requirement is only $25,000 per person. That might sound like a lot of money, but in the face of a serious medical event, it's a drop in the bucket. Your medical bills alone are $80,000. Plus, you've lost $10,000 in wages. Your total damages are $90,000. The at-fault driver's insurance company will write you a check for their policy limit, which is $25,000. And that's it. That's all they are legally required to pay. They've fulfilled their obligation. So where does the other $65,000 come from? Again, without the right protection, it comes from you. You're left holding a massive bill for an accident that wasn't even your fault. This is the exact scenario that underinsured motorist coverage, or UIM, was designed to prevent. With UIM, after the other driver's insurance pays out its $25,000 limit, your own policy kicks in to cover the rest, up to your UIM limit. If you had $100,000 in UIM coverage, your policy would pay that remaining $65,000, making you whole again. It's a safety net that catches you when the other person's safety net is full of holes. Now, a common objection I hear is, well, I have really good health insurance. I don't need to worry about medical bills. That is a dangerous and false sense of security. First, even the best health insurance has deductibles, copays, and out-of-pocket maximums that can easily run into the thousands of dollars after a major accident. Your UMBI coverage can pay for those. Second, your health insurance might deny certain treatments or specialists that are critical for your recovery. Third, and most importantly, your health insurance will not pay you a single dime for the wages you lose while you can't work. It won't compensate you for permanent scarring, long-term pain, or the trauma of the accident. Uninsured and underinsured motorist bodily injury coverage does all of that. It fills all the gaps that health insurance leaves behind. So how much of this coverage should you get? The answer is simple, and it should be a non-negotiable rule for every single driver. You should carry uninsured and underinsured motorist limits that are equal to your own bodily injury liability limits. Let me say that again. Your UM/UIM limits should match your bodily injury limits. Think about the logic here. Your bodily injury liability limit is the amount of protection you've chosen to provide someone else if you cause an accident. Let's say you chose $100,000. You have decided that up to $100,000 is an appropriate amount to cover medical bills and lost wages for a person you might injure. So why on earth would you give yourself less protection than you give to a total stranger? It makes no sense. If you believe $100,000 is what's needed to protect them, then you absolutely need $100,000 to protect you and your family. Protecting yourself from the 1 in 8 uninsured drivers and the countless more underinsured ones is not a luxury. It is a core, fundamental necessity of any responsible insurance policy. For the relatively small cost, it provides an astronomical amount of financial peace of mind. So your car is fixed, and your major medical bills from the surgery and hospital stay are covered by the other driver's policy or your own UM/UIM coverage. You've avoided financial ruin. But what about all the little things? The things that pop up immediately after the crash? What about the bill for the ambulance ride? The visit copay? The prescription painkillers? What about the weeks of physical therapy copays that are coming? And a more pressing question: how are you supposed to get to work tomorrow while your car is in the shop for the next 2 weeks? There are specific, incredibly low-cost coverages designed to solve these exact problems, and ignoring them is a classic and very painful mistake. Let's start with the first one, the solution to getting to work when your car is out of commission. It's called rental reimbursement coverage, and it's one of the best bargains in the entire insurance world. For the price of a fancy cup of coffee once a month, typically just $3 to $5, this coverage will pay for a rental car while yours is being repaired after a covered claim. Think about that. The average daily cost of a rental car in the US is around $50. If your car is in the shop for 2 weeks, that's 14 days. $50 a day times 14 days is $700. You'd be on the hook for that entire amount, all because you tried to save $5 a month. The math is just brutal. Paying $60 a year to avoid a potential $700 bill is a no-brainer. This isn't a luxury. For most working Americans, it's an absolute necessity. Don't skip it. The second micro coverage that packs a huge punch is towing and labor, or what's often called roadside assistance. Again, we're talking about pennies on the dollar, maybe $1 or $2 a month. For that, you get a 24/7 lifeline. Dead battery in your garage on a freezing Monday morning? Covered. Ran over a nail and have a flat on the side of the highway? Covered. Locked your keys in the car while rushing to an appointment? Covered. They'll send someone to jump your car, change your tire, unlock your door. Or if the problem is more serious, they'll tow you to the nearest repair shop. Without this coverage, a single tow can easily cost you $150 or more, instantly wiping out years and years of the potential savings from skipping it. It's not just about the money, it's about the peace of mind. Knowing that you're one phone call away from help, no matter where you are, is worth far more than the loose change it costs. So we've covered the small add-ons that can save you from major inconvenience and moderate expense. But now we need to talk about the mistake that doesn't just cost you hundreds, but can cost you everything. This is the one that can lead to financial ruin, and it's centered around one of the most dangerously misunderstood coverages on your entire policy. It's the coverage that protects you from the single biggest variable on the road: other drivers. Let me ask you a question. What happens if the person who hits you, who is clearly at fault, has no insurance at all? Or what if they only have the bare minimum required by the state? Who pays for your medical bills? Who pays for your lost wages when you can't work for 6 months? Most people incorrectly assume, well, the other driver was at fault, so their insurance will cover it. That is a terrifyingly naive assumption. According to the Insurance Research Council, 1 in 8 drivers in the United States is uninsured. That's nearly 13%. And in some states like Florida and Mississippi, that number skyrockets to over 1 in 4. That means on any given day, you are sharing the road with millions of people who are breaking the law and have absolutely no ability to pay for the damage they might cause you. This is where uninsured and underinsured motorist coverage comes in. And you need to listen to this part very, very carefully. This coverage protects you, protects your family. It protects your finances from irresponsible people. Let's break it down into 2 parts. First, uninsured motorist bodily injury, or UM. Let's say you're driving your family to dinner. You're stopped at a red light, and a driver, distracted by their phone, plows into the back of your car at 40 miles per hour. You and your spouse suffer serious back and neck injuries. Your medical bills quickly climb to over $100,000. You find out the driver who hit you let their insurance lapse. They have nothing. They also have no assets to their name, so suing them is pointless. Without uninsured motorist coverage, you are on your own. Your health insurance might cover some of the medical bills, but what about the high deductibles and copays? What about the months of lost income because your injuries prevent you from working? All of that comes directly out of your pocket. Your life savings, your kids' college fund, your retirement, all of it is at risk because of someone else's mistake. But if you have uninsured motorist coverage, your own insurance company steps in and acts like the at-fault driver's insurance. It pays for your medical bills, your pain and suffering, and your lost wages, up to the limits you selected. It's a shield that protects your entire financial life. The second part is underinsured motorist bodily injury, or UIM. This is just as important and maybe even more common. In this scenario, the at-fault driver does have insurance, but they only bought the absolute legal minimum. Let's say your state's minimum bodily injury liability is $25,000 per person. That's all they have. But your medical bills alone are $100,000. Their insurance will write you a check for their policy limit of $25,000, and that's it. They are legally off the hook. You are left with a $75,000 gap. Where does that money come from? Again, without UIM coverage, it comes from you. But if you have underinsured motorist coverage, your policy kicks in to cover that difference, paying that remaining $75,000 so you can get the treatment you need and get back on your feet without going bankrupt. People skip or cheap out on this coverage all the time because they think, I'm a safe driver, I won't cause an accident. You're missing the point. This coverage has nothing to do with how safe you are. It has everything to do with how unsafe or irresponsible the millions of other drivers on the road can be. You are not insuring your driving habits. You are insuring yourself against theirs. So what's the right amount to have? Here is one of the most valuable rules of thumb in all of insurance, something your agent should tell you but often doesn't. Your uninsured and underinsured motorist coverage limits should, at a minimum, mirror your own bodily injury liability limits. Think about the logic behind this. It's profound. When you choose your bodily injury liability limits, say $250,000 per person and $500,000 per accident, you are making a statement. You are saying, I have assets and a future income worth protecting, and I believe a serious accident could cause up to this amount in damages. Therefore, I need this much coverage to protect myself financially if I hurt someone else. Now turn that logic around. If you believe it's possible to cause $250,000 in damages to another person, it is just as possible for another person to cause that same amount of damage to you. If you need $250,000 to protect your assets from a lawsuit, why on earth would you accept less than that to protect your own body, your own health, and your own family's financial future if an uninsured driver hurts you? Choosing lower UM/UIM limits is essentially saying that your own well-being is worth less than a stranger's. It makes no logical sense. Protect yourself as well as you protect everyone else. Match those limits. So now you understand the pieces of the puzzle: liability, collision, comprehensive, and these crucial add-ons and safety nets. You know the classic costly mistakes to avoid. But the final billion-dollar question remains: how do you take all this knowledge and actually get the best possible price without sacrificing the protection you now know you need? How do you shop smart, find the right company, and uncover the hidden discounts that can save you hundreds or even thousands of dollars a year? That's where the rubber meets the road, and it's exactly what we're going to break down in our final part. First, let's reframe this whole process. Shopping for car insurance isn't a chore. It's a game where the prize is keeping more of your own money. And the rules are simpler than you think. The number one non-negotiable golden rule is this: you must compare quotes. Not one, not two. I'm talking 5, 6, even 7 different quotes. Why? Because every single insurance company uses its own secret recipe, its own complex algorithm to decide what you'll pay. One company might see your 2018 Honda Civic and think, safe, reliable, low risk. Another might see the exact same car and think high theft rate in that zip code, higher risk. The difference in their quotes for the exact same coverage could be staggering. We're not talking about $10 or $20. We're talking about hundreds, sometimes over $1,000 a year. So, how do you gather this intelligence? You have 3 main paths. Path 1 is going direct. This means you go straight to the websites of the big players: Progressive, Geico, State Farm, Allstate, and fill out their quote forms yourself. The pro here is that you're dealing directly with the source. The con: it's time-consuming. You'll be typing in your name, address, and vehicle identification number over and over again. Path 2 is using an independent agent or broker. This is a licensed professional who doesn't work for just one company. They work for you. You give them your information once, and they shop it around to a dozen or more insurance companies they have relationships with. This is a fantastic option because they do the legwork, they can offer expert advice, and they can often find niche companies you've never even heard of. The potential downside is that no single agent represents every company, so you might still be missing some options. Path 3 is using online comparison websites. These are the aggregators you see advertised everywhere. You put your info in once, and they spit out a list of quotes from multiple carriers. This is the fastest way to get a bird's-eye view of the market. The caution here is that these quotes are often estimates, and your inbox might suddenly get very, very busy with follow-up emails and calls. So what's the winning strategy? A hybrid attack. Start with a major comparison site to get a quick lay of the land and identify 2 or 3 potential frontrunners. Then, contact an independent agent to see if they can beat those prices or offer better coverage. Finally, take the best quote you found and go directly to one major competitor, maybe your current insurer or a big name like Geico, and see if they can beat it. This multi-pronged approach ensures you see the widest possible range of options and leaves no stone unturned. But wait, the biggest mistake you can make is choosing your insurance based on price alone. The cheapest policy is only cheap until you actually need to use it. A $50 a month policy from a company with terrible customer service is worthless the moment you're standing on the side of a highway, trying to get a tow truck, and their claims department puts you on hold for 45 minutes. This is what we call the moment of truth. And you need to know with absolute certainty that the company you choose will be there for you when that moment comes. So how do you vet a company? You become a detective. First, check their financial strength. This sounds complicated, but it's not. There are independent agencies like AM, Best or Standard & Poor's that give insurance companies a report card on their financial health. You want a company with an A rating or better. This simply means they have the cash on hand to pay out claims, even in a major catastrophe. You can usually find these ratings right on the insurer's website or with a quick Google search. Don't sign up with a company that has a weak financial report card. Second, investigate their customer service and claim satisfaction. This is where you check their reviews. The 2 most important sources are J.D. Power, which does massive annual surveys on customer satisfaction for everything from the shopping process to the claims process, and the National Association of Insurance Commissioners, or NAIC. The NAIC maintains a national database of consumer complaints. You can look up any insurer and see their complaint ratio. It tells you how many complaints they get relative to their size. A company with a ratio below 1.0 is better than average. A company with a ratio above 1.0 gets more complaints than you'd expect. This is public data. Use it. It's the difference between choosing a 5-star restaurant and a place with a C rating from the health inspector. Now for the part you've been waiting for, the discounts. This is where you transform your premium from acceptable to unbelievably low. Most people know about 1 or 2 discounts. We're going to build an entire arsenal. When you're getting a quote, you need to be proactive. Don't assume they'll find every discount for you. You need to ask. Let's run through the ultimate checklist. First, the basics. Are you bundling? Combining your auto insurance with a homeowner's, renter's, or even a life insurance policy from the same company is almost always the single biggest discount you can get. Do you have multiple cars? Put them on the same policy. Are you a good student? If you or a driver on your policy is in high school or college and maintains a B average or better, that's a discount. Can you pay in full? Paying your 6-month or annual premium all at once instead of in monthly installments can save you a surprising amount in service fees. And are you signed up for paperless billing and automatic payments? Yes, they will literally give you a discount just for saving them the cost of a stamp. Okay, that's level 1. Let's go deeper. Have you taken a defensive driving course? A state-approved course, which you can often do online in a few hours, can knock 5 to 10% off your premium for 3 solid years. The math on that is a no-brainer. Now for a huge one, your occupation and affiliations. Are you a teacher, a nurse, a doctor, a scientist, an engineer, a first responder, or active or retired military? Many companies offer significant discounts to people in these low-risk professions. Are you a member of a specific alumni association, a credit union, a professional organization, or even a wholesale club like Costco or Sam's Club? These groups often negotiate massive, exclusive discounts for their members that you can't get anywhere else. You have to ask about these by name. What about how you drive? If you work from home or have a very short commute, you need to declare a low-mileage discount. Less time on the road means less risk, which should mean less premium. And this brings us to the modern-day game-changer, telematics, or usage-based insurance. This is the program where you use a small device in your car or an app on your phone that monitors your actual driving habits. Things like how hard you brake, how fast you accelerate, the time of day you drive, and your total mileage. Yes, it's a privacy trade-off. But if you are a genuinely safe driver, this can lead to the largest discounts available, sometimes as high as 30 or 40% off your base rate. Turns your good habits into real money. Don't forget your car itself. Does it have anti-lock brakes, airbags, an anti-theft system, daytime running lights? Make sure every single safety and anti-theft feature is listed on your policy. They all add up. Is your car brand new? There's a new car discount. Is it a hybrid or an electric vehicle? There's a green vehicle discount. Finally, there's the loyalty discount. And here's the beautiful irony. The best way to get a loyalty discount from your current company is to prove you're not loyal at all. After you've shopped around and you have a better quote in hand from a competitor, call your current insurer. Tell them you've been a happy customer but you have a better offer. Ask them directly, can you match this? Or can you find any other discounts for me before I switch? Suddenly, they might just find that loyalty discount they never mentioned before. So let's put it all together. The master plan. Once a year you block out 2 hours. You gather your quotes using our hybrid strategy. You vet your top 3 companies for financial strength and customer service. You take the best offer, and then you go down our ultimate discount checklist one by one with the agent on the phone squeezing every last dollar of savings out of that policy. You have now completed Car Insurance 101. You've gone from a beginner who saw insurance as a confusing and frustrating expense to an expert who sees it as a financial tool you can control. You understand your coverages, you know your responsibilities, and now you have the exact playbook to ensure you are never, ever overpaying for the protection you need. This knowledge doesn't just save you money today. It saves you money every single year for the rest of your driving life. The power is officially back in your hands. Now go use it.